Hi, welcome. Did you know that banks are using lots of data science in their daily operations? In this video, I'm going to share with you three applications of data science in banks. Stay tuned and let's dive straight to this video. 1. Market segmentation. Banks are interested to grow the wallet share for customers. So, looking at historic data and the transactions already performed by the customers, the bank is interested to segment the customers into their income level, expenditure level, risk taken, so that cross selling can be done and also personalized offers can be offered to these profitable segments to also make them grow, and segments that are not that profitable to be managed well so that they don't bring down the profitability of the whole bank. And that is where data science comes in, because data science has tools like k-means clustering, hierarchical clustering, which helps segment the customer base into these various clusters so that the bank can be able to achieve its objective of increasing the wallet share and also increasing revenue from managing profitable segments better and trying to also manage the least profitable segments. 2. Fraud detection. Fraud detection is a huge problem for banks as well, because it's not usually about the money lost only, it's about the confidence the customer loses in the bank when there is from fraud in his account. So that is why banks take fraud prevention very seriously. And data science is very good for that because it's a real-time solution. They have to detect the fraud in real time. And with techniques like k-means clustering, support vector machines, logistic regressions, the data scientist is able to master the normal behavior of a customer. And as soon as the customer has a strange behavior, there is a suspicion that maybe the credit card has been stolen. Say, for example, the customer is used to withdrawing this average maybe after every 3 days, this certain average, and then all of a sudden we find the customer withdrawing a very huge amount. The model is going to give a signal either for some second verification to be done so that they can confirm that it is actually the customer, because this is an abnormal behavior, and that is why the model is able to identify in real time abnormal behavior and take an action based on what action they have requested the model to take after realizing the abnormal behavior. 3. Risk mitigation. Banks have lots of risk, and there is always need for the banks to measure risk and manage risk. That is why data science, with all the tools to collect all the data and bring them together and be able to assess and come up with risk values, is very, very effective in banks. It's also very applicable for customers when they want to get loans, like to determine the credit worthiness of a customer. So usually a data scientist model will be used to give a score to the customer who is requesting a loan. So a customer with a very low score would mean there's too much risk giving loan to this customer, while the customer with a very high score would mean, okay, we can go ahead and give the loan to this customer. And typically these scores are gotten from past behavior, from merging many data sources, many information on transaction, the ATM transactions, deposits, withdrawals, and all of that. They come to build a model which is able to predict which customer would easily default in a loan in future and which customer won't default in a loan. That is how data science is used to help credit risk management. There you have it. 3 applications of data science in a bank. If you have any comments, leave the comment in this video. If you like this video, click on the like button, subscribe to this channel.